Are you an operator that wants to think like a PE firm? When it comes to consolidation, that might be a good idea. That's what we're talking about today on education. So, in today's episode of education, we're going to get into consolidation. It's something that a lot of PE firms look to do to create value, and there's an element of this where you can kind of replicate this in your own businesses as you look to maybe acquire smaller companies within your space. Um, and it's a playbook that's fairly replicable, and can be a very you know value accretive strategy for you as you look to build out your existing company and you ultimately sell it. So, without getting too far into it, I just want to jump into a couple numbers here for you. So, imagine, if you will, let's say you have a company that's doing 5 million in EBITDA, and you're valuing it at an 8x multiple. So, 8 times 5, that gets you to a 40 million valuation. Now, imagine if you're able to buy a company that's doing 1 million EBITDA for at a 4x multiple. So that company is valued at 4 million. But when you roll that company into that 8x company that's worth 40 million, it's not combined, it's not worth 44 million anymore, because you have that 8x multiple valuation applied to your company. It's not 4 million being added to the value of your company, it's actually 8 million. And that's ultimately the playbook that a lot of these private equity firms are uh, you know doing, as far as roll-ups are concerned, is this idea of multiple arbitrage. You're buying a handful of companies at a lower multiple, and once they're all brought into a platform, and all the rough edges are smoothed out, and the synergies are realized, those the sum of the parts is worth more than or like the total aggregate is worth more than the sum of the parts. So if you can buy companies at, like I said, a 4x multiple, and they're getting rolled into a company that by the end of it, because of its higher EBITDA, can justify higher multiple on that EBITDA as far as the valuation is concerned, you're able to really enhance the overall value of the company. So, um, so again, it's a for a listening audience, I try to keep the numbers fairly straightforward. 8 times 5 is obvious, 4 times 1 is obvious, but when you get those lower, but the bottom line is, you're buying companies at a lower multiple, combining them together, and because you have a larger value company as far as the EBITDA is concerned, now you're able to sell at an even higher multiple, and you're getting a lot of value added to that. And um, a lot of that's really just because you're doing kind of the hard work, as far as big private equity firms, for example. They're not looking to buy 1 million EBITDA companies. The larger check sizes they write, they're not going to want to write a check for anything smaller than 50 million. So if you can position yourself where you're doing that, some of that dirty work for them, they'll be willing to pay that 8 or 10 times premium multiple, where you can do a lot of the legwork of buying those 2 to 4 to 5 times valuation companies. And once you get them all rolled in together, you can potentially be the one selling that at an 8 or a 10x, and being
Yeah.
the one realizing that that multiple expansion. So that's kind of the crux of the value proposition that this strategy is entailing. And we're going to go into a couple examples of private equity firms that have realized this model to varying in varying industries. And as we talk through them, really start to think of how you can apply this to your existing business. Let's say you're a company that's doing 5 million in revenue and 1 million in EBITDA. Are there companies that are doing 500,000 in EBITDA that you can bring into your company,
Yeah.
um, where maybe your company's worth a 4x multiple? You're able to find companies at 2 to 3 times earnings, or something to that effect, where you're able to kind of realize this same strategy, and not just look towards organic ways of growing, as we talked about in the previous episode, as far as customer funded growth. But obviously there's a really compelling thesis of buying these companies at you know values that are smaller, and they can even be, in some cases, especially as we talk about acquisition financing, and especially below the 5 million threshold of the SBA, where you can get some pretty compelling debt terms. And as we also talk about seller financing in some of our previous episodes, you can really get a lot of these, companies without a lot of cash needing to be deployed, at least like in terms of your internal, company's funds, where you can, get this done with a lot of debt. Like, let's say you're a debt-free company, you can find a company of equal size, but be able to finance it principally with debt. And, the overall debt burden of your combined companies isn't really that extreme, even though you used a lot of debt to finance that acquisition. And again, because let's say you're that $1 million company and you're buying a company of equal size, and now all of a sudden you're a 2 million EBITDA company, maybe you're worth, a 6x multiple instead of the 4x, and you've immediately added to the valuation of your company because now you're a bigger company. Um, you know, Larger companies will pay more of a premium because again, you've done some of that dirty work for them as far as consolidating, in this case, one company, but ideally it could be a couple over the span of a few years, where you can really start to realize that increase in valuation in it, especially for private equity firms. If you can demonstrate that playbook and the ability to um, successfully acquire and roll in these other companies into your own company, really demonstrates to other private equity firms, when you do look to ultimately sell, that this is a company that can has a playbook already established and has the capacity and team that is able to work these companies in. Right, Christian?
Yeah, I mean, this shows that what we spoke about in the last couple episodes, but it shows one that you have a repeatable process, which is what everybody wants to see. Two, that it's not really dependent upon yourself, which also will increase whatever valuation you may have. And three, and third, most important to you is this gives you a really good bargaining chip because, like as Steven said, instead of we'll call it a metaphorical house, like if you go and buy a fix and flip house, think of the PE firm that wants to come in and buy the house as if it was clean and new with all the infrastructure redone, new kitchen, new bathrooms, new bedrooms, so forth and so on. So that allows you to have a really good bargaining chip, and at the same time it really shows your value too, because a lot of times whenever these PE firms will come to you, sometimes they like to have you stay on just for continuity, or they may see that you have an eye for this, so they want to keep you on sort of the payroll and even maybe work out a sweet deal with you where you could possibly get some sort of the back end for ultimately whenever they absorb this and sell it to somebody else. But regardless, no matter what, thinking this way can only help you. It's like knowing in like football terms, knowing the defensive strategy before the game is even played. But this is actually happening all across different sectors. It's not just select industries. We have it in like home services, dental, veterinarian, and healthcare. That's kind of a new one. Industrial distributions, auto body, car washes, funeral homes. I don't know if many people here saw the one interview with, I think it was Akon, but he has like a pretty large car wash that he's actually rolled up himself. So it's a pretty interesting strategy. But the point I'm trying to show with that is anybody can do this. And it's actually a great way to kind of think to put yourself within the best position. Now, we do have a couple examples for you here. Our first one is the Heartland Dental. So, what Heartland Dental was, it was a essentially the dentistry business, and who actually ended up purchasing it was KKR. Excuse me, I'm trying to pull up my notes here. So, in 1997, Dr. Rick Workman in Illinois saw that dentists are clinicians; they're not operators. They're really good at actually being whatever their trade may be, such as cleaning mouths, making sure that there's cancer, no growth, so forth. But they're not obviously the most business savvy people. So what he decided to do was he thought you could centralize the billing, the HR, the procurement, and marketing, and the same practice procedures, but kind of in more of an EBITDA on the same chair count. And so kind of what happened was you had KKR that kind of came in, saw what they were doing, the patient satisfaction scores, the treatment outcomes, the regulatory compliance history, all were very measurable, and they're obviously show that it was a quality clinic, and KKR obviously like that. Once again, they showed that they're able to actually roll these dentistries up in together, and I think they actually ended up buying over 1,900 practices. But the constraint wasn't really buying more, but it was more so onboarding each one without disruption. So this is what we were kind of talking about. So if you have if you are going to buy a business yourself, so let's go to we've mentioned this before, an HVAC business. We do have an example of this, a real world example. We have a client of ours. He's currently trying to buy another HVAC business, but the owner wants to retire. He doesn't want to stay on, which is great for our client. However, he doesn't have any CRM systems involved. It's on a post-it note, a bulletin board. I think he has a different dealer, correct, than the
I
original
believe,
one.
yeah.
So you can't just slap on anything onto whatever your business is and expect it to go working completely fine. So what he had to do is he had to figure out what the actual agreement is within the current dealer or rep that he represents. And at the same time, he has to figure out how to work in both that location and his original location so that, he doesn't cannibalize himself or miss out on any opportunities. But once he gets working together and that becomes a solid unit that actually works together or works as one, then that's whenever you start seeing some payback. Because if you have, like, for instance, this doctor one or dentistry one, if you have 1,900 practices, each of them are a disaster, that's not going to be very helpful. You didn't do any dirty work. Instead, you just kind of combined a bunch of nonsense together. But
Yeah, and that's why the back office scalability. I mean, I think underpinning a lot of this and to really make sure it's properly done is making sure that you're centralizing systems and really making it sure that you know you don't want these companies working in silos, right? So
yeah,
ultimately the bottom line is integration is going to be the important key. Both in terms of synergies and just the overall importance and value of the platform. So so as Christian had mentioned, you have this Heartland Dental here, and a huge thing was just the infrastructure in the back end aspect of it. And going back to the HVAC client example, when you look at these companies, at least from his perspective, if you see a guy who's doesn't really have a traditional CRM, it's
hmm
using a bulletin board, you're pinning stuff onto a cork board type of thing and keeping track of your customers that way. It's like, well, that's an immediate, way that I can, add value and bring my, CRM and we're talking about a company that's, doing, less than a million EBITDA, but still, in a position to be able to do,
yeah,
these types of acquisitions, for smaller HVAC companies. But, it's not like they have a huge, IT infrastructure, but, you have cloud services, getting them onto your CRM, getting their existing clients into your CRM, making sure your accounting is, good, using a QuickBooks, all these different types of, tools to make sure they have a seamless integration into your company, and that ultimately that will result into some you know probably cost synergies, maybe a opportunity for cross-selling. But for something like this where it's
hmm
all in the same vertical, typically looking at cost synergies. But again, if you're doing, in his case, he's probably doing 500 in EBITDA, and buying a company that's doing 500, excuse me, thousand, right? So still a fairly small company, but a very prime example for maybe our listening audience where you may have a team with 10 or so techs, and you're not quite in that next phase of or next step of really scale, but there still might be those opportunities to buy a company that's doing a million a year in revenue and doing 200, 250 in EBITDA, where, the sooner I can break into that 1 million EBITDA threshold, all of a sudden I've, again, as we talk about, these multiples and these gradual stepping stones, once you get that past that 1 million EBITDA threshold, that you really get into another universe of potential buyers.
hmm
And, just, it,
It really just makes you that much more attractive.
yeah, and you become, you know, 1 million is kind of that, that threshold you may want to hit if you're, below that number, where that kind of puts you, that's probably going to add, if you were worth, 3 or 4x multiple, if you're under 1 million now, that, immediately, moves up a turn to maybe a 4 or 5x multiple. And as look to not just grow internally, but maybe find these, acquisition opportunities. And the other appealing thing for him in this case was, you know, the likelihood, it's still kind of pending, but the likelihood of getting this mostly seller financed.
Mhm.
So you're looking at a company that, isn't requiring, any cash coming out of your company to help finance this. It might be a little bit of it, but it seems like you might be able to get it done with a, seller note, because again, he's operating in this, not just a geography, but just a, we talk about these valuation companies, company that's doing 250 in EBITDA, they're not getting their doors knocked on from, private equity firms, even lower middle market ones necessarily, you know, wanting to, buy their company. So by being able to, find these types of opportunities, and especially if you're getting them seller financed, um, you're immediately, I think if he does this acquisition, actually would get him, close to that 1 million uh, threshold.
Oh, it would.
But,
Yeah.
and all of a sudden that immediately, it helps you, it takes you up to the next level, so to speak. If we look at these multiples as kind of milestones or, um, stepping stones, it's like, if you're sub 1 million, you're probably looking at a 2 to 4 multiple range. And like I said, after you get to that 1 million EBITDA threshold, all of a sudden, not, not only are you worth more, it's part of a function of just a larger universe of buyers being available, which can help drive up that price. Um, but overall, it's just going to be more meaningful to you. So certainly, if you're in that space where maybe you're doing between 500 and a
Mhm.
million EBITDA, 500,000 to a million EBITDA, what are some opportunities in where I can try to find these types of companies that can help me get to that next level, and ultimately that can really be meaningful to your bottom line. And again, if you can get seller financing terms, that's even better.
Yeah. We did have another HVAC example, but I'd prefer actually just to stick with ours. But um, usually to work on these and to kind of make yourself look better, and this is kind of why we keep harping on a lot of these due diligence items. Uh, for instance, we've mentioned this before in last episodes, like owner dependencies, client concentrations. So forth and so on. The reason why we harp on these is because this is exactly what's going to be able to tell the prospective buyer exactly how well your business is operating and how well it's functioning. So the more you can think like them, sort of the better outcome you'll get out of this situation. So we do have the 6 work streams on our visual side. So for our listening audiences there, once again, please go to YouTube. uh, First one is financial due diligence. So when you're looking for a prospective company, these are kind of like the basic ones to look for as far as these due diligence items go. So for financial due diligence, you want 3 years of financials, adjusted EBITDA, reconciliation, accounts receivable aging, customer concentration, debt schedules. This also will look at, mortgages, tax returns, kind of anything within that field you kind of want to know about. Because once again, you are going to be taking over this business. So you kind of want to know where all the skeletons hide and if what they're saying is actually true about the business. But the next one is operational due diligence. So this is your process documentation, key person dependency map. You need to know the tech stack, the capacity utilization, recurring revenue percentage. So when we mean by documenting your processes, this is what we had in the I think the third or fourth episode of ours. Uh, this is where you usually find slippage, or you may find some issues. So if your process right now is really dependent upon yourself, and let's say you go back to the HVAC example, really, if your whole process is so dependent upon yourself as the owner and that bulletin board and maybe your one tech that you may have, that's going to be an issue because that leads to that key person dependency. And you can tell, if you miss that bulletin board, or let's say a piece of paper drops, which, fighting gravity isn't always the easiest thing, you're going to miss out on an opportunity there. And companies will see that, and it's going to be harder to transition that company, if it's so dependent upon one person to become an upstanding and running on its own sort of business, then your tech stack is like your technology, so your CRM system, QuickBooks, emails, so forth and so on. And recurring revenue percentage, that's what we like to discuss. So if you're HVAC, this could be like your subscription agreements for maintenance. It could be for a membership club where they get certain perks or advantages for joining, such as like priority scheduling, priority pricing, so forth and so on. But once again, these are the items you really want to kind of go through with a fine comb before you kind of look into anything. The next one is commercial due diligence. So customer contracts, renewal rates, top 10 relationships, pipeline visibility, competitive position. So when we look at customer contracts, if you're going to once again go into purchase that business, you want to make sure that the current client contracts that you have will last beyond your actual time frame, so that you don't see a lot of those actually losing out on business early on while you're transitioning. So you may want to have to figure out a way to re-up those positions and those contracts so that they have a longer duration. Renewal rates, you want to make sure that what they have been doing has been good. So they have a lot of great past customers, past client relationships. People constantly look back to them for continued work. Because if not, then you might have an issue there with a branding problem. The top 10 relationships and who those kind of belong to. So once again, if that belongs to your one tech who's going to leave, if you leave, then you're going to have an issue there. Um, and that's kind of going to tell you exactly where your concentration lies as far as your client, concentration goes. So pipeline visibility, this is how many projects you kind of have bid on or are going to bid on or have access to. This will help you kind of forecast out what you can take over. And then competitive position is you want to make sure that you are buying something that has a sort of a well priced or item that has some like a name that has some meaning behind it. So for instance, you're not like the most expensive brand in the area. You may be the cheapest brand in the area, but it's something that people look to and they do have good business with. Um, Legal and compliance. This is your corporate structure, your outstanding litigation, regulatory compliance, employment agreements, IP and ownership. So corporate structure, you just want to make sure. So if let's say you have a roofing business and you need to, let's say the company that you're looking at has an office and they also have a warehouse where they get to stack their shingles and squares. You want to make sure that, one, how is the real estate portion structured? Is it under its own entity, like a real estate land management group? Then you have the roofing company all underneath one actual roofing company. So you want to look at that corporate structure to make sure you know what you're actually buying, because sometimes people will leave out the physical real estate of these transactions because instead they want you to be their renter, I should say. Outstanding litigation, obviously you don't want to buy anything that you're going to walk into a lawsuit and be liable for stuff that you never did. But if you end up purchasing over whatever corporation it is, obviously all that liability falls upon you. So please seek legal counsel for this. This is probably going to be the point where you do need lawyers to look at things for you. Regulatory compliance. So if you're in accounting, like if you're going to buy another accounting firm, you want to make sure that they've never fell out of accounting standards. Same with like physicians, so forth and so on. Whatever compliance industries within your business or sector or market, you want to make sure that the company that you're buying in has never overstepped their boundaries and they've always remained in compliance. Employment agreements, you want to look over through these to make sure that when you do purchase this business, you don't overstep your boundaries and accidentally fall into an employment lawsuit. You also want to make sure that everybody has under regulations that don't fall without the out of compliance, that everybody is kind of maintaining the right thing. And then IP ownership is obviously the intellectual property. It's a big one to know. Then you have your people due diligence, which is your management team, retention plans, org charts, comp structures, earnout alignment. So management team, if you have a currently HVAC company or a plumbing company and you see that the next company over does not have a financial controller, but you do, that may be something that you want to look at. Or if they do have a financial controller, that's nice to know that they're going to stay. Looking towards that management is nice because you want to make sure there's enough management there, but there's not too much bloating of management within that company. You also want to look at, how are you going to retain these employees? Is it that like we talked to a client recently, they do all sorts of fabrications for custom trucks and so forth and so on, for oil and gas, but they actually had two salesmen that were not actually on commission based incentives. So instead, they were just straight salary. So as you can tell, a salesman that's not really incentivized to sell isn't going to do too well. So you may want to look at that and revisit that with them. You got org charts. So this just shows where everything is labeled, who reports to who, so you can see what needs to be improved. So if you have everything going to one management person, then you're usually in an issue. A good example of this is office space. You got 8 different managers that you have to report to. Earn-out alignment. So this is once again making sure that if there is a discrepancy between the purchasing of the business price, that if I want to buy Steven out for, let's say we agreed on $1 million, but he thinks it could be worth 1.5, then we'd have X amount of time frame to make up to that 1.5. But obviously he's going to want that 1.5, so he's going to make sure that things are running smoothly until then. Then lastly, we got the integration due diligence. This is your day one plan. What consolidates immediately versus 12 months, back office roadmap, brand strategy. So once again, this is, you dot the I's, cross the T's. The keys are now yours. What exactly are you doing from day one? Are you implementing that CRM system? Are you moving them over to your sort of system or, tech stack immediately? What are you going to do? Are you going to re-update the employment contracts? Or are you going to, this is kind of what you need to start with. And then you want to look towards the future on how to build this out to make it more efficient and to be able to be less dependent upon those key persons, so forth and so on.
Yeah, and going on to the next slide here, there's two different. We're talking about this as both a buyer, but obviously in our previous episodes, we also talk about kind of how you position yourself as a seller. So a lot of the previous slide, obviously that's stuff we've covered from the seller's perspective, but also things to be looking for. Again, if you're viewing yourself as a acquirer of businesses, as you look to maybe roll up companies into your own to your own existing business, certainly things to keep out as well. But the a couple mistakes that you might encounter is assuming the diligence is the buyer's job. So again, if this is if you're looking to sell, this is really the preparedness aspect of really dotting your I's, crossing your T's, making sure you have a due diligence package in the lead up to selling. A concept we haven't really talked about a lot is the concept of retrading. A buyer during the course of the due diligence may see something that flag something that wasn't necessarily fleshed out or understood, or what have you, in the pre-diligence process where they start uncovering some rocks and see don't like what they see. They could end up retrading, and that basically means that 6x value that they had on you, they're now dropping to 4x because there's something that was flagged in due diligence that in their view could impact the valuation. Obviously consult advisors, but you'll want to commission a sell side quality of earnings before going to market. That's from a buyer, they're going to be requesting that, and that's going to uncover a lot of potential flaws within how you're reporting income. There's a lot of things that can be arisen. It's probably one of the probably top 3 things that can cause deals to go bust is just a improper, I guess, accounting, if you will, of your cash flow statement and your income statement. So you'll want to get a good quality of earnings. It'll be a good litmus test for your own business. And then also, if you're on the buyer side, something you'll definitely be wanting to request, because the last thing you want to do is you realize that these earnings were either fabricated or what they s- um, weren't what they said they were. We see businesses that um, you know the, the matching of revenue and revenue recognition to cash flow can be vary from business to business, but it's critical you kind of understand how that mechanism is making its way through the company's income statement. So um, if companies getting deposits for something on work that needs to get done, but maybe the
Mhm.
work doesn't actually get done, but that you know they that cash is in, but that revenue shouldn't have been recognized because that work wasn't done, but maybe it was recognized. Things like that that can pop up, um, where it's not there's a deferred revenue, or it's actually a liability at that point, where that revenue shouldn't be recognized yet. The work still has to get done, but it's being shown on the income statement as being done. So things like that can pop up. Um, and lastly, we talked about I don't know if we need to rehash the roll up math, but
Yeah.
really for people that are on the YouTube page, a little bit more of an illustrative example. But let's assume 5 businesses all doing 800,000 in EBITDA, and you're able to get all of them at a 4x valuation. So each one would be worth, 800,000 times 4. That's a 3.2 million valuation for each. If you bought all 5 of those together or over a period of time, that's 16 million in total acquisition volume. But once you get all those companies combined, and then also again, you work on some of the back office stuff, you integrate systems, and you're able to realize another 600,000 in synergies. And now, those companies that were, at a standalone were, only worth, a 4x times multiple at 800,000 is now a, 4.6 million EBITDA platform company that could potentially get a 10 times multiple on their earnings and have a valuation of 46 million. So I mean, that's a huge, leap in math, but that's the financial math we're talking about. And like I said, a lot of these companies, or a lot of the bigger firms, aren't necessarily looking to do these sub $100 million, excuse me, sub 1 million EBITDA acquisitions. So if you're able to do that dirty work, you can really see a lot of meaningful upside. So, if you get a platform exit in this example at 46 million on 16 million in acquisition, that's you're netting 30 million, and that's not even necessarily including distributions you're able to incur um, over the process of that, because it might be a 5-year period. So imagine you're getting 4 million in EBITDA for a period of a few years on top of the actual valuation, where you're getting a really high multiple on invested capital. And again, these aren't necessarily, a lot of this could be funded through the cash flows of the company. You might be able to get seller financing, um, or other types of, the SBA debt, again, as we talk about, sub 5 million acquisitions. A lot of ways to structure these with debt and the cash flows from the companies, where you can really, ideally be able to acquire some of these without a lot of equity funding necessarily, other than the earnings from the companies themselves. To be able to get these acquired without you know actual equity being used, where you're able to get these high multiples without really having to put a lot of your own money into it. So again, that's just how appealing this math is. And again, if you're willing to do this dirty work, private equity firms will will reward you handsomely. So
Absolutely.
um, it's and as we also talk about, um, you know, if you were to sell to private equity and you were able to demonstrate, being able to serially acquire, um, companies and roll them into a platform, that could also open the door for, there's operating partners are a really big,
Hmm.
you uh, thing that we see coming out into private equity firms, which, if you're a seasoned operator and have been able to demonstrate this roll up playbook, private equity firms will pay you handsomely to work for them too, as they, look to implement this strategy along their portfolio. So, can also turn in some really appealing professional exit opportunities as well, if you're able to, implement this strategy. But, yeah, bottom line, we've got, 2 choices, right?
You either get acquired or you acquire, baby. You got to be the shark or you are the shark.
Yeah. So, again, it's about, taking that mentality of, where can I create this value and can I take this private equity mindset into my own business as I look to, um, acquire businesses and really try to achieve and, capture some of that value myself before ultimately selling to private equity. Because, as we've demonstrated, you know, it's a very appealing, if you've already been in this business for 10, 15 years, take that opportunity and whatever existing runway you have, um, to, buy a couple extra companies before you ultimately sell, because that can really help pay off, when you do, ultimately sell. So ideally, if you have some runway still left, obviously we do talk to retirement
Mhm.
age people that are just looking to sell. But if you're younger, you have a 5 to 10 year runway. There's plenty of opportunity to uh, try to implement the strategy yourself, and then again capture that value in that multiple arbitrage, and um, you know be able to pocket a few more million before you sell.
Absolutely. So this is the episode, I think, number 7. But once again, you either are the acquirer or you get acquired, and sometimes it's best to be both. So thank you for listening.